Good morning, taxpayers! Hey, remember that show with Ty Pennington and his friends that would actually show up to a needy family's house? They would kick them out for a few days and they would tear down their old house. They'd start to build a new one, and if they had a kid that expressed any modest interest into anything, they would completely deck out their room for it. Then they'd bring the family back. They would say, move that bus, and then the bus moves, and they show the new house, and everyone gets teary-eyed, and it just makes you feel good. Right? Yeah, it was a really good show. But did you know that the entire show is actually centered around a central tax topic when it comes to rentals? That's right, the whole process of rental operations comes into play if you are a contestant on the show. Now, I should go out and throw the caveat out. I've never been on the show. I'm not a consultant for the show. I do realize it's been revitalized, but I'm not like on their staff. But anyways, if someone were to come up to me and say, hey, I got this idea for a TV show, and they explain to me, and it's just like the Extreme Home Makeover, then everything that I'm going to say is pretty still accurate because, again, it all comes down to, again, this central tax topic, which, again, is rental activities. Now, granted, if you were on the show, there are some other tax implications you need to consider. For example, if you get a bigger house, you're going to have increased utility bills. Also, now that the value of your home has increased, your real estate and property taxes are going to increase as well. Now, granted, since the show has been out of its prime for a few years, a lot of people have had struggles because, again, they got a nice bigger house, but there comes extra cost. And again, the people on the show just give them a better house. They don't give them a better job or a raise. So over time, there is a little bit of a gap that needs to be filled, or in this case, some people will actually lose the house, which I think has actually happened. But going back to the whole topic, how does the Extreme Home Makeover show actually center around tax law? Now, when it comes down to rentals, one thing we have to understand is if you rent your house out for less than 15 days during a calendar year, the rental income to the recipient is non-taxable. It does not have to be reported. But by the same token, any expenses against that income are also not allowed as well. So let's say, for example, you need a place to stay for the weekend. You come over to my house. I've let you stay for a couple of nights, and when you leave, you hand me a $100 bill. So $50 a night. Now, that $100 to me technically is non-taxable. I'm assuming that, again, I did not have any other people renting, or I guess staying with me rent-wise, or paying me rent throughout the year. So as long as, again, throughout this entire year, if the amount of days that you've rented out your house is less than 14, the amount that you receive is tax-free, Now, how does that come into, again, the point of the show? Now, what's probably happened is if you are going to be a contestant on the show, they're probably going to ask you a lot of questions about what your hardship is, what your story, and so forth. Because, again, it's a TV show. They want to make sure that they have the most needy family that they can on the show just to, again, for exposure. But one of the questions I almost guarantee is asked is, have you rented your house out any time before us coming out? And do you plan on renting your house again anytime after we leave until the end of the year? If the answer is yes, I can almost but guarantee they are not going to be on the show. Because here is how it really works. See, when you go onto the show and they meet the family and they send them on vacation, they have essentially 14 days to get the house completed and the family back into the home, or everything that they have done is taxable to the recipient, which can be astronomical. Now, going back to the example that I just gave, like you just needed a place to stay for the weekend. Again, you stay for 2 days, you give me $100. That's the only time I've rented out my house. That $100 to me is non-taxable. Now, let's say again, same thing. You stay for 2 days, but you gave me $10,000. Again, very generous of you, but again, if I did not rent out any other times throughout the year, and the only times, again, I rented out during the year was those 2 days, 2 is obviously less than 14, so that $10,000 in that example is still non-taxable to me. Now, again, this is one of the really few instances in the tax code where the measurement of time actually trumps the measurement of dollars. Because again, anything that happens under that 14-day rule is non-taxable. Anything over it is, regardless of dollars. Now, I'm sure there's probably exceptions, but that's the general rule. So in this case, how does the Extreme Home Makeover team make this a rental? Now, essentially what happens is, let's say hypothetically, they get a family on the show, and the value of their house before they come on was $100,000. So the family comes, or the show comes in, they meet the family, they look at the house. It's probably, again, an older house. It's probably decrepit. It's probably doesn't suit the needs of what they need now, whatever the situation is. But let's just say, again, $100,000. Again, they have 14 days to get the family back into the home, because essentially what's happening behind the scenes is that producers in the show are actually renting it during that period. And again, if they go over that 14-day threshold, everything is going that happened, again, incremental wise, and I'll get to that in a minute, is taxable to the recipient. And again, a lot of the people on the show have run into some financial hardships, so anything that's taxable to them can be extremely detrimental. So again, let's go back to this example. They have a house for $100,000. They're going to kick them out of the house, and they're going to go on vacation for a little bit, and that's when they start demolishing the house in order to get a bigger one. Now, what probably happens is they take the house, they get new furnishings, they get new appliances, new furniture, all of that stuff. So let's say hypothetically, the value of the house after the renovation was $400,000. So in this case, they started with a $100,000 home, they ended with a $400,000 home, but technically during that rental agreement, they want to go on a trip. Now the trip, again, probably was a week or so. So let's say it was a $10,000 trip. We can also argue that this needs to be included into, I guess, the rental price. So again, at a high level, let's just assume that you got back from your vacation, you're now standing behind the bus, you're waiting for Ty and his friends to say, hey, move the bus. You're looking at, again, $410,000 of essentially new items here in this case. A $10,000 trip, which again you just got back from, plus a $400,000 home and furnishings. Now, how do we make sure that gets non-taxable, again, to the recipient? Now, one of the things we have to look at is the incremental jump. So in this case, they had a house for $100,000. Now they have a house for $400,000. In this case, the difference, or the incremental delta, whatever you want to call it, is $300,000. So that technically is rental income to the recipient, even though it's not your traditional where, again, someone comes over, they stay for a few nights, eat your chips and whatever, and when they leave, they write you a check for $300,000. No, instead of getting cash, they're getting a house instead. But again, the house still has value, and that is kind of being picked up, or I guess substituted as your rent payment. But since they are legally able to essentially categorize this as a rental, they are actually being able to use this as tax-free, again, to the recipient. Now, I do remember some specific episodes. I tried to look them up and see if I can find them. Again, it's really hard to find full episodes, but there have been a couple that, when I look back on, actually make pretty good sense. There's some times where they were running short on their schedule, where they were coming close to not having the house done by the time the family got back, which sounds kind of an issue because, again, the family wants to come back and they want to see their house. But if this wasn't built around tax law, we could probably just say, well, hey, let's just send you on another vacation or whatever. That would probably be the easy answer. But it really boils down to that 14-day rule. Because, again, if they come back and it's day 15, the value of the trip, the value of the home incremental cost, the value of any other types of gifts, or I won't say gifts, payments or things that they have received once they've gotten back to the home would be considered taxable, because that would be considered a rent payment. So another way you can think about this is, let's take out the whole home renovation altogether. Ty and his friends show up to your house and they say, hey, you have a $100,000 house. We're going to send you on a $10,000 vacation, but when you get back, we're going to give you a check for $300,000, which again would be the incremental value increase of the house. You can argue that's really no different than what they're doing on the show. So instead of them just, again, writing a check for $300,000, they're actually giving you a $300,000 increase in the value of your home. So in this case, that is considered the rental payment. And because, again, if they get the house done and the family back before that day 15 threshold, all of this is tax-free to the recipient, which, that's pretty good. So again, if you've ever been on the show or watched the show and just have been amazed at how they can get everything done and the amount of volunteers within, again, that short amount of time just to get it done, again, by the time a family gets back from vacation, keep in mind, it's really just to help them avoid getting taxed because, again, paying tax on $410,000 is going to be, 310, I'm sorry, it's going to be $310,000. Paying tax on that could be, again, wipe anyone clean. So again, if you're on the show and you had to plan everything out from a house being deconstructed, torn down to a new one being furnished and ready to go within 14 days, that's some good planning there.